Right, guys, in my view, there are two super important things or critical factors you should always keep in mind before jumping into a trade. First, understand the bigger picture. In other words, you have to determine the bias or direction in which the market is heading. To achieve that, you should start looking at higher time frames like 60 minutes or 4 hours charts, which can reveal the broader trends without actually you getting distracted by the market short-term fluctuations or ups and downs. Once you have a sense of where the market is heading, you can then focus on the smaller time frames to find the best spots to enter a trade. Now, the second key factor in my view to understand here is that the market is usually trying to do one of two things. Either hunt liquidity, which usually involves targeting highs and lows via buy rate or sell rate zones, or generate liquidity by filling imbalance areas. Now, when the market isn't pursuing either of these goals, it tends to consolidate, creating obviously a range-bound environment with limited price movement. I believe that by keeping these concepts in mind and most importantly, incorporating them into your trading approach, you can get better at predicting market moves and adapt your strategy based again on whether the market is hunting liquidity, generating liquidity, or consolidating. The idea here is not to sort of fixate on a random level that looks interesting to you. Instead, let price action guide you in terms of you focusing on areas of the chart where objectively there is liquidity action and liquidity manipulation. That way, you'll see where the big players are making moves and potentially identify opportunities based on their actions. So keep your eyes peeled for those significant liquidity spots. Now, if we take a look at this 60-minute price action, it's clearly signaling, in my view, a potential short here. The obvious question is why? Well, first off, we have got this already completed AMD Wyckoff cycle here. And obviously, by AMD, I'm referring to the accumulation markup and distribution phases of the Wyckoff's method. As you can see in the chart, during the distribution phase, the market goes through an upthrust AD or buy rate move seen in this week, which grabbed all the buy stops resting above this level. After this fake breakout move here, and I do label this move fake breakout because in Wyckoff's terms, almost every distribution phase is followed by a markdown phase. So after this engineered, I would say, move, the market nosedives with an almost uninterrupted downward price decline, finding support at the 56.30 level. But this is where it gets really interesting because we then see an AMD repeat with the formation of a consolidation phase. This week, which shows market rejection and hints at a potential reversal, is immediately followed by this markup or rebalancing move that leads to another market maker buy rate or stop hunt zone. Now, although the correlation between these two variables here isn't as pronounced as the first correlation, it still qualifies, in my view, as a buy rate move, which is a clear market maker footprint and a solid bearish sign. So at this point, with the help of the 1 hour chart, we have been able to gain an understanding of the bigger picture, meaning we have got a pretty solid idea here on where the market is going after hunting liquidity above the 57.08 level. Also, these imbalance zones that I have marked out down here, particularly the first area that prints right at the Fibs 50% level, are very helpful in terms of indirectly reaffirming to us the market's bearish bias as it relates to its tendency towards an external to internal liquidity dynamic. By external liquidity, I'm referring to this buy rate zone as it gravitates, as you can see, towards the internal liquidity levels of this range. So now, guys, that we have identified the structure that supported the price, let's drop down to a lower time frame so that will help us in in finding an entry point for our trade. As you can see from this 2-minute price action, after 5708 level held, the market broke formation or structure rather convincingly. Notice, however, that after the market sells off here, it starts retracing into this imbalance zone, respecting it by only wicking into it before reversing downward. The price clearly trading in overbought conditions here, then starts moving sideways, respecting the imbalance zone, which has now clearly turned into a strong resistance level. Obviously, the plunging move that follows is a strong confirmation that we picked the right side of the market. And as you can see from the price action, my first target lined up nicely with the FIPS 50% level, which also happens to be a support zone. My last target was just a tad above the VWAP, serving obviously as a support point. Overall, guys, I should say that this trade, which lasted a while, performed quite well. I think that it was one of those external to internal trades where the market initially hunted liquidity at the top of the range and then strongly imposed the downside to rebalance equilibrium. And by external to internal liquidity hunting, guys, here I'm referring to Wyckoff's upthrust after distribution term, which is basically the market's tendency of hunting liquidity from external levels inside the range, which are the internal levels. And guys, if you want a deeper dive into similar liquidity-based trades, don't miss the next video. Alright gang, thanks for watching, and as always, hope to catch you all in the next one.